Most people have the largest chunk of their retirement nest egg in 401ks. At retirement, there are several options you can make with these accounts, and it can be tricky to determine which option is the best fit for you. In this video, we'll walk through everything you need to consider when making this important decision, and we'll share with you one strategy that is often underutilized but could potentially save you a substantial amount of taxes in retirement. Hi, I'm Josh Palmer, Director of Financial Planning with the Noble Group. I'm a certified financial planner and have more than 2 decades of experience in the financial industry. There are 3 primary options most people have with their 401ks when they hit retirement. The first option is to simply leave it where it is. Now, this is assuming that the company it's at allows this, but it's usually a more common option than people realize. Sometimes you just forget. You changed jobs and just got so busy with the transition you forgot about it for a while. However, this may not be the best option for you, and we'll explain why in a bit. The second option is that you can take a full cash distribution. Now, understand that the entire amount of the distribution is taxable at ordinary income rates. And if you have a large 401k balance, depending on your filing status, that could amount to 30% or more in federal taxes. And if you live in a state or local jurisdiction that also takes a cut, that amount could increase even further. Remember that the tax man always gets theirs, so take this into consideration if you want to go this route. The third option is to do a tax-free rollover to a traditional IRA. And if you have Roth 401k dollars, a tax-free rollover to a Roth IRA. This is generally the most common option people choose, and we'll discuss why in a moment. So with these 3 options, keep it, cash it out, or roll it over, what considerations should you be thinking about to make the best decision for you and your financial goals and intentions? First thing you need to consider is the cost of the 401k. With most 401ks, there are costs associated with the administration of the plan, record-keeping fees, and the underlying costs of the investments. With some smaller plans, we have seen costs of 401k operations between 2 and 2.5%. Now, I will say that 401k costs have come down in recent years, but it's still a small piece of the pie you're losing, and most of the time, those costs do not include personal financial planning or advice. So the question you should ask is, what's the total cost of my 401k? This answer is not always easy to find, and you may need to go to your HR department to get that answer. But when you get that answer, think about this. If your 401k has a good selection of low-cost investments and you don't need to access those funds for a while, it might make sense to leave it where it is. But if your 401k has high-cost investment options and personal planning and advice is important to you, then using the tax-free rollover option may be best. The second consideration is control. Now, your 401k might have low-cost investments, but it still may not be the best option because of control. So what do I mean by this? Some 401ks require paperwork and forms for every little transaction. Roth conversion, paperwork. Withdrawal, paperwork. Rebalance, paperwork. One goal we have for our clients is to reduce any worries related to finances so they can relax and enjoy retirement as much as possible. This might be hard to do if every little move is going to require a form or some sort of paperwork. And most of us will admit that the harder something is to do, or the more work it requires, the less likely we are to do it. There are also control issues when it comes to investments. Inside a 401k, the investments are selected by the record keeper or plan advisor. Now, there are rules that mandate a wide allocation of fund choices. For example, there will be large company funds, mid-size, and small company choices. There will be international options, fixed income or bond options, and even funds that correspond to your retirement year. But you don't get to pick which fund managers you use. And if those fund managers don't align well with your financial goals, you might be out of luck. And that leads us to the third thing to consider, and that's the investment options you have. Inside an IRA, you have many options to choose from. You can look at individual stocks or individual bonds, ETFs or mutual funds. You can direct it yourself or hire a professional money manager. Because your 401k is a group plan, you may be limited to what the company tells you you can invest in. Now, that's not always bad. Sometimes the fewer options, the better, and we can avoid suffering from analysis paralysis. But if you're someone that wants to have any and all investment options on the table, you may not prefer the limitations on your 401k. The fourth consideration is consolidation. We've had clients who have a variety of different managers and multiple 401ks spread across their past 4 or 5 employers. Now, on the surface, that may not be an issue, but there are some things to be wary of. For example, when you retire, where do you take your income from? How are the investments working together for your goals? Are your investments complementary or contradictive? In other words, do they work together for your goals, or is there too much overlap and redundancy? Allocation amongst asset managers is not allocation among asset classes. If your assets are too spread out, there are far more chances for missing something or not managing them to the full benefit of your financial goals. And lastly, let's talk about coordination with your financial plan. We believe in a bucket approach to your nest egg. This means that some investments are designated for shorter-term income needs and may be invested more conservatively, while others may be invested for longer-term needs and can be utilized more aggressively. This can be rather difficult to do with limited investment options inside a 401k, and especially across several smaller 401ks spread across multiple employers or managers. So that's a list of the things to consider when dealing with a 401k, either at retirement or when you leave that employer. Now, there are some things I do want to remind you of if you do decide to take advantage of that tax-free rollover option. If you have a Roth 401k, your contributions can be rolled into a Roth IRA. There are advantages to a Roth IRA we're not going to get into in this video. However, any company contributions may be tax deferred and need to be rolled into a traditional IRA. This also applies if you have made after-tax contributions to your 401k. This usually happens if you make too much or want to put more in than the deductible amount. Since you have already paid tax on these dollars, they will be considered to be rolled into a Roth IRA. But any growth of these assets will again be tax deferred and will need to roll into a traditional IRA. There's lots of moving parts here, which is why I suggest consulting a financial advisor before making any of these decisions. Our contact info is in the description if you want to set up a complimentary strategy session with us. When planning for taxes, think about your age at separation. If you take a distribution from a qualified retirement plan, such as a 401k or IRA, prior to 59 and a half, you're subject to taxation of the withdrawal and a 10% penalty. However, if you are separated from service, meaning you are let go, laid off, or retired, you can take penalty-free withdrawals as long as you are at least age 55. Once you roll this into an IRA, if that's the decision you make, this exception is gone. For example, we recently had a client come in who retired at 56. They needed immediate income, so we left 4 years of income in their 401k and rolled the remaining balance to an IRA. We took the income they needed until age 59 and a half to avoid the 10% early withdrawal penalty, then transitioned the income to their IRAs. At the beginning of this video, I also mentioned an often unused but potentially important tax saving strategy that you can only use with 401k assets. And that's called net unrealized appreciation, or NUA. NUA is an option if you have a substantial holding of your employer's stock in your 401k and the cost basis of that stock is low. If you roll all that company's stock to a traditional IRA, there are no taxes paid at the time of rollover, but income taxes are due upon any distribution of that stock at ordinary rates. NUA affords you an opportunity to pay ordinary income taxes on the cost basis of that employer's stock, but then pay a more favorable capital gains rate on the unrealized appreciation of that employer. Now, I realize this may sound a bit complicated, so let's look at a recent example we had with a client to show how this can work. Christopher came to us with a 401k he was wanting to roll over to an IRA. Upon analysis, we found that he had $400,000 in employer stock within that 401k. After calling his HR department, we found the cost basis of that stock was only $20,000. So we wanted to show Christopher what would happen if he held that employer stock for 10 years. It's a high quality company and a stock that many of our money managers hold. We also determined that he was in the 30% tax bracket and 15% capital gains bracket. In this scenario, by using an NUA strategy, we showed a potential tax savings of almost $100,000. Now that means a couple of things. One, we will owe about $7,000 in taxes now, and two, we must roll the entire 401k out by the end of the calendar year. But by doing this, we now have $400,000 in high quality stock with $380,000 in gains. That in Christopher's case will be taxed at the lower capital gains rate of 15% instead of his higher ordinary income rate at 30%. So to recap, the NUA strategy means we're taking the stock portion of your 401k and rolling that into a non-qualified, non-retirement account, paying ordinary income taxes on that cost basis while rolling the remainder of the 401k to a traditional IRA. Now, it doesn't always work as well as it did in Christopher's case. Maybe the cost basis of the company's stock is not that low, or there are not many unrealized gains in that account. But if we see company stock inside a 401k, it's always something we try and any good financial advisor should look at before blindly rolling any 401k into an IRA. because once the company stock is outside the 401k, this option is off the table. So ultimately, taking these considerations into account when you hit retirement can help you ensure you're making the best decision for you and your family's financial goals and intentions. If you want to get a personalized look at your finances, including your own retirement picture, click the link in the description. We'll review your financial situation in a custom video recorded just for you. Have a great day, and we'll see you in the next video.